In this section, we're going to cover other corporate tax levies. The C corporation can be used to reduce taxes even though there's the double taxation problem. It still might be beneficial for high earning individuals with high marginal tax rates, to facilitate income through a corporation. This is because top individual marginal tax rates for ordinary income can be 40.8%. Dividends can be taxed at 23.8%, but the top corporate tax rate is now 21% because of the Tax Cuts and Jobs Act. So it may be preferable to put all trade, business, and income producing property in a C Corp and then either retain those earnings in there or pay out dividends, and it still may result in less total tax dollars paid. So the C corporation could distribute dividends to shareholders, which might result in a lower overall tax liability, or it could delay distributing anything until the shareholder is in a lower tax bracket, or the corporation could just hold assets in the corporation. All earnings can be held into the corporation, and then when the taxpayer passes away, the shareholder taxpayer passes away, the basis of the stock would get a stepped up basis. That means at death, the basis of the shares would be increased to their fair market value, which would cause any of that built-in gain to go away. So it would be tax-free. This works until we consider the personal holding company tax and the accumulated earnings tax. So these two taxes are the IRS's answer to this accumulation. The personal holding company tax is going to apply to corporations used to shelter passive income from higher individual tax rates. And a personal holding company is now less popular because dividends are taxed at a lower rate than they used to be. They're lower than the highest corporate marginal rate. But what this does is it's a pretty complicated calculation, which I'm not requiring you to understand the calculation, but I am requiring you to understand the concept of the tax and how to avoid the tax. So the concept of the tax is to add an additional tax, an additional personal holding company tax on top of the normal corporate income tax. And that personal holding company tax is calculated at 20%. And that 20% matches to the highest qualified dividend rate for individuals. So when an individual receives a qualified dividend, the tax rate paid on that is tiered either 0, 15, or 20%. So the personal holding company tax matches that highest 20% rate on the dividends. To be a personal holding company, there are two requirements. There's a stock ownership requirement and a passive income requirement. The stock ownership requirement says that more than half the value of the stock is either directly or indirectly owned by 5 or fewer individuals, and attribution rules do apply. Those are found in section 544. So 544 attribution rules say that for the purposes of determining whether a corporation is a personal holding company, stock not owned by an individual, so stock owned directly or indirectly by or for a corporation, partnership, estate, or trust shall be considered as being owned proportionally by its shareholders, partners, or beneficiaries. So if a corporation, partnership, estate, or trust owns shares, the owners of that entity will be treated as owning those shares. Also, an individual shall be considered as owning the stock owned directly or indirectly by or for his family, or by or for his partner. And for the purposes of this, the family includes only brothers and sisters, spouse, ancestors, and lineal descendants. If a person has an option to acquire stock, the stock shall be considered as owned by such person. For purposes of this paragraph, an option to acquire such an option, and each one of a series of such options shall be considered as an option to acquire the stock. So again, the 544 stock attribution rules apply when we're talking about over half the value of the stock being owned by 5 or fewer individuals. The personal holding company also has a passive income requirement. If we meet both of these, it's a personal holding company, not just one. The passive income requirement says that at least 60% of adjusted ordinary gross income is personal holding company income. And S corps and tax-exempt organizations are excluded from the personal holding company definition. So this is how we calculate adjusted ordinary gross income. And again, I'm not as concerned that you memorize this or can calculate this. You can always look this up, but I do want to go through it so you kind of understand the definition. So the gross income is the same as that reported for taxable income. So this is exactly the same, just like on the corporate tax return. From there, we subtract gross gains on the sale of capital assets and gross gains on the sale of Section 1231 property to get ordinary gross income. And from there, we exclude certain expenses related to gross income from rents, mineral, oil, and gas royalties, and working interest in oil and gas wells. And a few other things, and then we arrive at adjusted ordinary gross income. And remember, that's important because of this second passive income requirement. At least 60% of adjusted ordinary gross income is personal holding company income. Okay, so personal holding company income is going to include dividends, interest income, annuity proceeds, royalty income, and distributions from an estate or a trust. All right, so these are what we normally think of as passive, right? We don't go out and work for these. The corporation doesn't go out and provide services to earn this type of income. This is personal holding company income, but there are some exclusions here. Exclusions from personal holding company income include income from certain rents, certain oil and gas royalties, certain copyright royalties, film rents, computer royalties, personal service contracts, and rental of property by a greater than 25% shareholder. This is how we calculate the tax. Again, I don't care so much that you can calculate the tax, just that you understand this calculation. So we start with our regular taxable income and we make adjustments. The first, on the plus side, the positive adjustments, we add back the dividends received deduction because it's not allowed when we're calculating personal holding company income. The net operating loss deduction is altered a little bit. The net operating loss is only allowed for the immediately preceding tax year. So we add it back in this plus side and then we subtract it back out on the minus negative adjustments. Number 3, excess charitable contributions carried over from a preceding tax year and deducted in the current year in determining regular taxable income. Our charitable contributions are more closely matched to the way we calculate them for individual income tax purposes, so that's when we make adjustments. And then number 4, net loss attributable to the operation or maintenance of certain property owned or operated by the corporation. We subtract out accrued U.S. and foreign income taxes. We subtract out the current year charitable contributions that exceed the 10% corporate limitation. Again, this is to more approximate the corporate deduction to the individual deduction for charitable contributions. The net operating loss computed without regard to the DRD incurred in the immediately preceding tax year. And again, this is the change in the way we deal with net operating losses between the corporate limitations and then the limitations that apply to the personal holding company. And then we subtract net capital gain minus the amount of any income taxes attributed to it. We subtract the dividends paid deduction. We're going to talk about what that means coming up, but basically remember that the goal of this personal holding company tax is to prevent corporations from retaining a lot of income in the corporate structure and not distributing it out because the IRS wants to make sure the corporation and its shareholders are paying enough tax. So the amount of dividends we pay out is going to reduce the personal holding company income, which is going to reduce the personal holding company tax. So we get the undistributed personal holding company income, and we tax that at 20%. That's my personal holding company tax. Remember that 20% is the same as the highest tax rate on dividends, unqualified dividends. And remember that this personal holding company tax would be paid in addition to the income tax that the corporation has to pay. Okay, if we want to avoid the personal holding company designation, we can do this by increasing the dividends paid deduction. Okay, so on this slide, we're going to talk about how to increase the dividends paid deduction. So the easiest ways to do that are current year dividends and throwback dividends. Current year dividends are dividends paid out in the current year to the extent of earnings and profits, but they don't include preferential dividends. And preferential dividends would happen if a shareholder basically gets more than their share of dividends. So they own 20% of the stock, but they get 100% of the dividends. That would not count in dividends paid deduction. We could also pay throwback dividends, which are distributions paid in the first 3.5 months after the close of the tax year. They're subject to a dollar limitation, and an election may be made to treat these dividends as a dividend distribution made in the prior year for personal holding company tax purposes. Okay, so that would work. We could also make consent dividends. We would make consent dividends when we didn't have enough money to actually pay dividends. So consent dividends are hypothetical dividends deemed paid to shareholders on the last day of the corporation's tax year. They permit a corporation to reduce its personal holding company tax liability, even though it's prevented from making an actual distribution due to a lack of money. So here, the shareholder is deemed to have received a distribution, even though they haven't. The shareholder will pay tax on that, and then the shareholder is deemed to contribute that amount of money back to the corporation, and that would increase the shareholder's basis in their shares. Okay, absent these types of dividends, we can avoid the PHC designation by making one of the three on your screen: deficiency dividends, dividend carryovers, or liquidating dividends. So liquidating dividends will allow a dividends paid deduction for the liquidating dividends made by a personal holding company within 24 months of the adoption of a plan of liquidation. Deficiency dividends are when a corporation determines it owes the penalty tax, but it wants to avoid paying that tax. It can do that by electing to pay a deficiency dividend. So if they elect that, an income tax is levied on the dividend payment at the shareholder level instead of at the corporate level. And then the shareholders include the deficiency dividend in their gross income for the tax year in which it is received, not the tax year in which the personal holding company claims a dividends paid deduction. And then finally, dividend carryovers are allowed. So dividends that are paid in the preceding 2 tax years can be used as a dividend carryover to reduce the amount of the current year's personal holding company tax liability. The amount eligible for this dividends paid deduction is the amount that exceeds the undistributed personal holding company income for the 2 preceding years. It can be carried forward and claimed as a dividends paid deduction in the current year. So if we'd paid more dividends in previous years, I can carry it forward 2 years to reduce my personal holding company tax liability in the current year. In which of the following situations will small corporation be deemed to be a personal holding company? Assume that personal holding company income comprises more than 60% of small's adjusted ordinary gross income. So remember, to be a personal holding company, we have to have more than 60% of our income coming from personal holding company income. And then we also have to have ownership of more than half the corporation in 5 or fewer shareholders. So we already know that the personal holding company income is more than 60% of small's adjusted ordinary gross income. So now all we're focusing on is the greater than 50% ownership in 5 or fewer shareholders. Okay, so in Part A, Art owns 100% of parent corporation stock, and parent owns 100% of small stock. Parent and small file separate tax returns. Okay, so now we know, because of our attribution rules, that Art is going to be deemed to own all of small's stock. That's because Art owns all of parent, parent owns all of small, and remember, the shareholders are deemed to own the stock owned by corporations in which they own stock. B, Art owns 1/3 of small stock. The PRS partnership, of which Phil, Robert, and Sue each have 1/3 capital and profits interest, also owns 1/3 of small stock. The remaining shares of small stock are owned by 50 individual unrelated shareholders. Okay, so we know that those 50 individual unrelated shareholders are not going to be included in getting to the 5 shareholders owning 50% of the shares of small stock. But we know that Art owns 1/3 and PRS owns another third. But Phil, Robert, and Sue are each going to be attributed the shares of small stock that PRS owns because they are related to PRS partnership, which is related to small stock. So together, Art, Phil, Robert, and Sue own 2/3 of small stock. So that is greater than 50% in value of the stock owned. So yes, this is a personal holding company. C, Art and his wife Becky each own 20% of small stock. The remaining shares of small stock are owned by the Whitaker Family Trust. Becky and her 3 sisters each have a 1/4 beneficial interest in the trust. Okay, so now looking at Becky, we know because of attribution rules, Becky is going to be deemed to own all of small stock. She's going to get 20, she owns 20 directly. She's going to get 20% from Art because of family attribution, and then 15% indirectly from the trust, and then 45% constructively from her sisters.